Okay, folks, we are live. Welcome to Thursday Night Stock Charts Live. We're going to be talking about Dell Computer, a blast from the past, a stock I haven't traded since 2000. We're going to talk about the valuations of the market. We're going to talk about economic data. It ain't good. We'll talk about the CRB inflation index. We'll talk about PMI and supercore inflation and where I think stocks are going. So let's get to it. So let's begin with Dell Computer. This was for those that are too young to remember, Dell Computer was the hottest stock in the PC market when PCs came of age. And what a mind-boggling stock that was. It was the NVIDIA of its day. Fast forward, post-2000, dead money up until a couple of years ago. And honestly, I don't even track the stock. I don't even think about the stock. And sure enough, it let the AI genie out of the bottle today. And sure enough, the stock has rallied. So they raised their dividend. We'll go over the forward-looking guidance in a moment. I didn't see it posted yet. I'm not seeing forward-looking guidance here. So the revenue fell 11% from a year ago quarter. That's not good. The company reported net income 1.16 billion. All right, so they beat on what appears to be, so they saw less in revenue, yet their EPS grew. That's pretty good. That's pretty good. So it looks as though their margins are expanding. Servers and networking revenue made up a bulk of that, 4.9 billion, blah, 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 blah. AI optimized servers, there you go. That's the rub. That's what's killing the shorts right now. Our AI optimized server momentum continues with orders increasing nearly 40% sequentially. Wow. And backlog nearly doubling. So that's guidance right there. They have a backlog. They have a pipeline that is logjam. That's good stuff. Except this is a hardware maker and there's competition out there. So they better get their act together. And who's one of their major competitors? We'll go to that in a moment. Okay, so good report. And here's the stock after hours off of the highs. So here's what usually happens. And I've seen this all the time. Now I'm an early riser and I was up at 4 o'clock this morning, as I am usually every morning, and taking a look at when the institutional investors have access to the market at 4 a.m. And if this closes at or near its highs of the session at 8 p.m. Eastern Standard Time, more likely than not, when the institutions open up at 4 a.m. Eastern Standard Time, you're going to see a move up higher. So I would be okay with buying here on spec and probably just sell a rally and get out. I don't know if I would stay around here too long. Let's see how the stock does. I mean, Domino's Pizza did the same thing the other day. I watched at 4 a.m. It opened up, moved up higher. Then what happened? Reversed. Still closed up, but it reversed off of its highs. So I would, on spec, I'd be okay with buying it. I would sell the short covering rally tomorrow morning. Okay, so that is Dell. Did any other explicit forward-looking guidance come out? No. There's not much about forward-looking guidance. I'm sure that conference call is over with now. So, okay, it be what it be. That is all the news that's fit to print. Jody, welcome, the lovely Jody, the esteemed, the venerable Jody, and Mr. Sean. Yes, I have loved Dell for many years. I have them currently. I've never found better reliability. The stock price, I can't offer any rationale. It's all about the AI. So it's all it comes down to. Abercrombie and Fitch, mind-boggling sharp. Yeah, well, they have that brand, man. They screwed up a little bit with their marketing. They went woke for a little while, but they got back on track. 400% gains. Hormel chili this morning. What's that symbol? HML? No. Here we go. HRL. HRL. This usually has pretty expensive options. I see it all the time. What do? They had earnings? Yeah, earnings. I like their corned beef hash. I haven't had it in a long time, but I got to tell you, that corned beef hash, I had it as a kid a bunch of times. And man, that was good stuff. There she is. Talon, hey, brother. Okay, so let's move on. So we went over Dell. Let's talk about valuations, okay? So the markets had a nice rally today. We saw a surge this morning, and I'll be honest with you, I bought put options into that morning rally. Those options became very profitable. I kept them on as a hedge. Right now, I'm actually underwater on them, and I may have to take them off. I'm skeptical about this market. I know the NASDAQ has new closing highs today since 2021. I get it. I'm still very, very skeptical about this market. We're going to talk about the weekly charts in a moment, and I'm going to give you my thoughts about where to from here in a moment. But I have been bullish on the market. We still have long positions on, but slowly but surely building, nibble on some of these stocks that have come a long, long way and are due for a pullback. Now, they look like they're going to go up higher, and we never want to underestimate the ability for a meltdown, right? Especially when you're at all-time record highs. So I'm not going to fight the market. If I'm convinced that I'm wrong, we're going to stop out and we'll enjoy the ride up higher. So it's not just because they say I'm short, I'm building short positions does not make me a bear. I'm not a bear. If we do get a correction here, I don't think that it's going to be a burst of a bubble. I think it's going to be a 5-10% correction. So, and that's it. I'll be happy with that. I'll cover my shorts, look to get long until such time as it appears that this market is in trouble vis-a-vis rising interest rates, vis-a-vis a steepening yield curve. We're not there. We were there on yields. We were there on the yield curve. They have both backed off. Therefore, the path of least resistance remains higher, longer term. Are we susceptible for a pullback? Yes, indeed, we are. Let's move on. Okay, so one of the reasons why we're susceptible to a pullback in the markets is that the economic data, in fact, I'm going to go over the economic data first to drive home my point. The economic data this week has not been good. New home sales, miss. Durable goods, big miss. They expected negative. They got more negativer. That's not a word. I just made that up. Copyright pending? It's patent pending. Copyright pending anyway. It's my show. Durable goods minus transportation, missed. Consumer confidence, missed. GDP, missed. Initial jobless claims, that actually beat. Personal income, that's a problem. I'm sorry. I bleed red, white, and blue. I love my country. Love it to death. America, love it. I love when a guy makes an extra buck in his pocket and can spend that extra buck. The problem is Wall Street hates it. The government hates it. The Federal Reserve really hates it when you could put an extra buck in your pocket. Why? It's inflationary. You have an opportunity to go spend it. They want to take it away from you through inflation. So companies need to pay out more for their employees because some companies appreciate their employees. Personal spending came in as expected. Core as expected. Core PCE as expected. This does not include super core. We'll go over that in a moment. Okay. Tomorrow, we get a lot of data, folks. Manufacturing, PMI. We are in contraction in manufacturing. We get the ISM manufacturing numbers coming out tomorrow. If they come out hot, guess what happens to yields? They go up. If it comes out weak, yields go down. So thus far on the week, economic data has been net negative. So what's the Fed Watch tool telling us about the expectations for a Federal Reserve ease? Certainly, most certainly, what the Federal Reserve is expected to do is to cut rates sooner now, because look at this. It's a basket case of an economy. Well, let's check it out. The May number dropped. The probability of an ease is now basically off the table. This was a sure gone conclusion at 100% last month. Now, non-existent. In fact, 1 month ago, the probability of being unchanged was only 11.7%. Think about it. Now it's 80.2%. Going out to June, this was a foregone conclusion. Not anymore. It's borderline. This has actually popped up since I last looked. Let's refresh this. This was down to 62. It popped back up. Okay, good. And July, that was about 85. It's about the same as what it was. So the probability of a cut in May has declined with all this economic data coming out negative. I think the problem is this. This number right here, personal income. They hate it. It's the largest input cost that any company has, employees, and they're getting pay raises. So I love it. I think it's a great thing. But unfortunately, the Federal Reserve does not appreciate the fact that you are doing better. So GDP, let's talk about the milieu that we find ourselves in. Because think about this. We had GDP first revision 3.3%. How the heck did we get that? How the heck, with all of this data coming out horrible, how is it possible that our GDP is growing at 3.3% when it usually trends up at around 2%? What's going on here? Simple. US GDP grew at $334 billion in Q4 The cost of that growth was $834 billion in new debt hitting the market. So what this GDP growth, smoke and mirrors. Smoke and mirrors. It doesn't exist. All it is the government borrowing and spending, and producing nothing worthwhile. And they'll tell you, well, we're going to ship arms over to the Ukraine, and that's going to come back over here. Okay, that's a way to grow your way to prosperity through war. Wonderful. Now, the Federal Reserve has been dropping off debt off of its balance sheet. And this looks like a respectable chart. It's a good thing that they're doing this. But you need to put things into context. And the context is this. We are significantly above, still significantly above on their balance sheet where we were pre-pandemic. Add to that the emergency spending that Congress was authorized to do. The president was okay with that emergency spending in 2020, 2021, 2022. It's only gone up. It hasn't gone down to pre-pandemic levels. It's only gone up. On what emergency? Good luck reining in that horse. So I'm not going to pontificate here. I'm just going to stick with the script of the show. This is from Schiff Gold. My guess is Peter Schiff put this together. 10 serious and recurring economic fallacies that our leaders cannot or will not stop projecting. I'm not going to go through the text. The broken window theory. Okay, broken window theory is that suppose I own a glass shop, and I go over and I throw a rock through somebody's window, and they call me up and they say, "Hey, yeah, somebody broke my window. Can you come on over?" "Oh, yeah, I'll come over. I'll replace the glass." But wow, the frame is broken around the window as well. So I got to call my frame guy in, the carpenter in. He's going to fix this. And by the way, your other windows are going to have to match up to this now. They're old. You may as well replace them all. So all of a sudden, now you get all of this artificial spending. The only reason why it started is because you had a malicious event that took place. What's the malicious event? Is that we have criminals in Congress, criminals in the White House. So this is growing GDP. The benefices of war. Okay, I never saw that word before. I've heard beneficiaries of war or beneficiaries. Anyway, they're stoking the flames of war to sell goods. U.S. arm dealers export those goods. They use trains, trucks, seaports to export those goods. What happens? Those revenues come home, maybe, unless they're sub companies that have shell companies over in the Grand Caymans. Maybe they come home and they pay taxes. Maybe they don't. But that's what we're told to believe. It's all okay. It's all coming home to be spent here in the United States. It's going back to our treasury coffers. Yeah, right. So you're going to spend 116 billion over in Ukraine, and you're going to get what? 5-10% in corporate income tax off of that? That's your return on capital? I'll say no to that. Thank you. No, thank you. Myth 3, the best way to finance a war is borrowing. Well, look no further than here. They're not rolling off debt off their balance sheet. Luckily for the Federal Reserve, they have a treasury market that is absorbing all of this debt until such time as they don't. When they don't accept all of that debt hitting the marketplace, you're going to see two things happen. One, bond yields go like this, along with treasury bonds going like this. And the day that that event occurs, meaning bond yields surge and bond prices plummet. I'm not just talking about a pullback. I'm talking about a plummet. In all probability, the US dollar will tank as well. Why? it's going to be the death knell. It's going to be the global economy saying we have no confidence in these crazy people over in the United States anymore. These people are nuts. They're out of their minds. We can't lend them any more money, not at this rate. And what happens when they won't lend us this money, the money that we need to keep this game of musical chairs going? Well, rates go up like this, and the cost of borrowing goes through the roof. And then all of a sudden, to keep the power, they're going to need more money. So either they're going to be seizing 401k accounts, raising taxes, a mixture of both, whatever. But they are cut. That's the reason why they hired 60,000 IRS workers. They know the day of reckoning is coming. It's just a matter of when, and they need money to retain their power. We mean nothing to them. They look down at us with hatred. They need that money to retain their power. Simple as that. What else do we have here? Deficit spending benefits the economy and global debt. Yes. Government policies to promote exports are a good idea. All right, we've seen enough here. I agree with the first three. He gets into the weeds on the rest. All right, commercial real estate. I didn't really want to go over this. I was going to save this for last, but another pension fund sells a Manhattan office tower for $1. Think about it. Think about the loss that they just incurred. $1. Survey-based, not the establishment survey, but the survey-based slump continues as prices paid accelerates in plunging PMI. So yeah, the purchasing managers index going down with prices going up. Here you have it. Under the hood, new orders fell at a slower pace, signaling contraction. Employment fell at its fastest pace, signaling contraction. Inventories fell at a slower pace, signaling contraction. Now, another way to look at that line there is inventories fell slower. Let's reword that word there, that sentence. Inventories are growing. They're getting backlogged. What will retailers need to do? They will need to cut prices. What does that do to their earnings? Go down. Supplier deliveries fell and the direction reversed, signaling contraction. Production fell at a faster pace, signaling contraction. Order backlogs fell at a slower pace, signaling contraction. Worse still, prices paid rose at a faster pace. Folks, this is the textbook definition of stagflation. Stagflation, stagnant growth with inflation. Supercore inflation soars in January. Services costs reaccelerate as government handouts spike. Again, going back to this number here, why do we have a GDP at 3.3%, 3.2%? Why? Excuse me. You have the government doing handouts. What are those people coming over the border with $10,000 Visa cards going to do with that money? They're going to spend it. They're going to spend it. And it's going to do what? Inflation into the economy. Non-producers, they don't have jobs. By law, they're not allowed to have jobs. Unless, of course, they get work permits. So they have no productivity, yet they have capital to spend on the same goods that you need to buy. What happens to the cost of goods? Same thing after COVID. It's the same thing. Prices go up because of stimmy checks. This is the reason why we find ourselves where we are right now. What happens when these people that have no jobs need medical care? Guess where they're going? To the emergency room. What happens to the cost of services at the hospitals? It goes through the roof. What happens to our premiums through our health insurance carriers? It goes through the roof because these people can't pay the bill. The bill gets sent to us. It's inflationary. What you have coming over the border is government-sponsored inflation. There's no other way to put it. Delinquency rates for multifamily housing higher than the great financial crisis. Tick tock. Every time I see a report like this, in the back of my mind, I see a clock, and it's just like it's getting closer to zero. I hear tick tock, tick tock, tick tock. The day of reckoning. It's going to happen fast. It's going to happen fast. CRB. This is your commodities index, CRB. And what you're looking at here is a chart that is in a wedge formation. Let me re-illustrate what this is. And there's no guarantee this is going to break out, but it's looking pretty good, and not good in a good way for consumers. Cup, handle, no breakout yet, but we are darn close to a breakout here on the CRB index. The cards and phones as well. Yes, thank you. Okay, so cup handle formation, cost of goods is going up higher. There's just no way around it. So if you're wondering why after all of this negative economic data are we not getting the Federal Reserve or market participants taking this survey and saying, okay, you know what, the economic data is pretty bad here, so we had better start thinking about cutting rates. Well, how do you cut rates? How do you cut rates when you have GDP at 3.2%? How do you do that? How do you cut rates when you have personal income that is rising more than 3 times the expected rate? Now, this is 1 month. This is not a sequence of months, so 1 month does not make a trend, so I'm not trying to be hyperbolic here. It's all about the trend. What else? And how are you going to cut rates when you have a government that is helping stoke the flames of inflation? How do you do that? So the interpretation that I have right now in this crazy, crazy environment that we find ourselves in is that we're living on the fumes of pause is okay. A pause is okay as long as there's no threat of a rate hike. The market is okay at current until such time as we get a breakout on the 10-year yield to a 5 handle. Once that happens, it's going to be very, very difficult for this market to move up higher. But guess what happened today? Yields dropped. So what happens tomorrow if economic data, the PMI comes out hotter, we get strong economic data? Well, those yields just may reverse and proceed up higher. And that will not bode well for the equity market. So the best thing that can happen tomorrow is that you have a series of economic reports that comes out tomorrow, and they are bad. Not good, but bad. Bad news is good news. Good news is bad news. As sick and as perverse as it is, I didn't make it up. That's the way it was when I got here. That's Wall Street, folks. So CRB. Now, one chart that I don't talk about often, but I check in on it from time to time, is the skew index. And basically, this is a measure of speculation in the out of the money options market. And it's a good way of taking a pulse check for the mentality of traders. Who's out there? Who's driving this market up higher? Is it institutional money still, or is it more so the retail investor coming late to the game? And it doesn't mean as soon as the retail investor gets here that the game is over. It just means that, all right, you're on the red carpet and you're walking down that red carpet waiting to head into the auditorium for the big gala event, which is the boom, the blow off top. So where we're at current, and I drew these lines a while ago, at least a year ago. So in red is about the mean of where we have historically peaked out prior to going into a correction. And you can see overlaid here back in 2018, we pierced this upper band in red. Let's call it overbought, okay? Lack of a better word. Let's treat it as an oscillator. In red, you have overbought. In green, you have oversold. So, and you do that tongue in cheek. Just because it hits, it doesn't mean you go shorting the market or dumping your stocks. It just tells you, you know what? Keep an eye on this thing because things can get real fast. So in 2018, we pierced it. What happened? That was, I believe, the taper tantrum, and we sold off. Fast forward, we came close back here, February of 20. We all know what happened back then, COVID. Fast forward here, 2021, you had the big post-COVID rally. It still continued on for a few months. We hovered around here, and then we got the 2022 bear market. Guess where we're at yet again? And we've been here now since June. Since June. We've been hovering around this mark, and the highest, most recent high was back in December, and we are back flirting with this resistance level yet again. And overlaid here is the S&P 500 above, and you can see that we continue to ignore it because you have a lot of speculators in there now. And we're going to go to a chart of the S&P 500, the major indexes on a weekly basis. And I'm going to show you the volume of this rally that we're seeing right now. It doesn't mean that we're not going to continue up higher. It just means that this rally's on fumes. And at some point in time, we're going to get a correction here. And the Federal Reserve is going to need to be out there saying, oh, no, we got you back. We got you back. Don't worry about it. June, July, they'll float the trial balloons. You're going to get these Fed heads out there giving their speeches, and they'll float a balloon. Oh, don't worry about it. And all of a sudden, you see a rally in the market because it's all about carrot and stick. This is the carrot and stick market. So just be careful. We are speculative right now and subject to a correction. Now, the S&P 500, I mentioned earlier, I bought some put contracts on the S&P 500 on this morning's surge up higher. So right near the high, I bought the put contracts, and I was actually positive on them. I could have booked a profit, but I didn't because I was worried about the S&P 500. And we'll go to the weekly chart in a moment. And we had broken down yet again below this rising uptrend channel, but this 505 mark is holding a support. So what are we doing right now? We're trying to recapture a prior support level. Now, I'm very skeptical of this, and 9 out of 10 times you're not going to recapture that support level because there's a reason why it broke. There's not enough buyers up there. And you need a really good reason for it to rally back yet again. Now, you may be looking at this same chart that I'm talking about here and say, wait a minute, Bob, whoa, calling you out on this, calling you out. Wait a minute, your very own chart here shows right back here that we broke this lower band of support. What do? We recaptured it. What are you talking about? You don't know what you're talking about. What this was here was a catalyst. This was NVIDIA's earnings. This gap up. So this is a speculative fervor that hit the market because of NVIDIA. Now, here we are yet again, breaking the lower band of support with earnings, for the most part, with the exception of, didn't Salesforce.com report tonight? I've been thinking about Dell, but I think they reported. What was that last night? That was last night. Salesforce already reported. And that stock did not do much. So by and large, the earnings reports are done. You're going to get FedEx out, and that's pretty much it. I believe FedEx still comes out. So, warning flag on the track here. Now, I mentioned earlier that volume was running in light. It came in well today on SPY, but you can see here the trend of volume has been very, very low. Let's check it out on the SPX out of curiosity. Yeah, it was good today. All right, so when you're taking a look at this on a weekly chart, volume's pretty light. One trading day left to go. I mean, it's going to be very, very difficult for the markets to make up this gap between the moving average in red relative to where we are at current. It's probably going to be a light week. So just be careful. When we'll go to other weekly charts in a moment, stick around. So China. This is a chart. I'm going to go over another chart in a moment of U.S. versus Chinese equities. And what this writer is trying to point out here is, do we have a double top on the U.S. equity markets? No, we don't. I don't believe that we do. And do we have a double bottom on the Chinese equity markets? I question that as well. I think that China, and I said this back in here, China, this is just the latest case of China trying to basically get rid of the free markets. China bans high-frequency tradings as quant trading crackdown expands. I don't have a big problem with this. The one benefit that we get from high-frequency traders is, frankly, you get liquidity. You get a lot of liquidity. You take that away, and your spreads widen out. So there's a downside to cracking down on high-frequency traders. Granted, they have a license to steal, but there's a downside as well. They also banned short selling. Several countries out there, I think France banned short selling, but it's really a desperate move to save a system that's just really breaking down. And when you take a look, and this is why I get so concerned about the U.S. equity market, is that when you take a look at the historic performance, this is the FXI, the Chinese large cap index. In Candlestick and in black, you have the S&P 500. And you could see going back to 2006, strong uptrend, correlated up here, tightly correlated, generally about 70%, 75% of the time, at times, tightly correlated, at times much higher. But on average, let's just call it 70 to 75% to be fair. So a pretty good correlation. That correlation all ended back here in October of 2022. What happened back then? Well, what happened back then is that you had Congress come out with the stimmy checks, Federal Reserve, zero interest rate environment. So they were flooding the system. And I mentioned back here, I was live on a TrendSpider webinar. The equity markets in the United States were still going up higher. And I said we're going to get a correction here really quick. I'm bearish on crypto. I'm bearish on the equity markets, and they're probably going to break down. And the guy who was interviewing me, I looked at me, he's like, if I had three heads. And he's like, why do you say that? Because I'm peeing on his party. I said, China. Nobody's paying attention to this. Nobody. And I went over the charts, and finally, not even a month later, we went into free fall. So China, I mentioned back then, is uninvestable. What they had done was worse for their country than what we did to the US dollar by weaponizing it when Russia invaded Ukraine. They had the world by the gonads, and they simply just burst their own bubble. They became uninvestable. I've been saying it for years now. China is uninvestable. Might I speculate in it? Sure, with options. I'm not buying their stocks. I don't know. They don't have the proper accounting to even trade here in the United States. They get a special dispensation from the SEC. So the question is here, is China done going down? Maybe, for all I know. I don't know all that much about China markets. I look at the charts. All right. Chart says maybe a double bottom. What am I wrong about the stock market over in China not being investable? I think never. When am I wrong about the stock market over there being done going down? When it breaks out. When it breaks out. It has yet to break out. Maybe this is a double bottom. Maybe it's not. But if we fail, I'm telling you right now, if we fail to hold this lower band of support here, and we fail to hold this prior low here, last seen back in late 2022, we're coming down here at a bare minimum to the lows of 2009. So am I an investor in China? I talk about it sometimes vis-a speculation, but I'm not dying to get involved over there. And the question then becomes, as we back ourselves further and further into a corner here in the United States with the crazy debt spending, at what time do we begin to reestablish the old correlation of China and the U.S. stock market pretty much trading in tandem, tightly correlated? And if that correlation resumes, what are the probabilities that it's the Chinese stock market catching up to a continuing rising U.S. stock market? Or will it be that you have the U.S. stock market playing catch up to the downside to the Chinese stock market? I'm throwing the question out there. I don't have the answer. But with the behavior of our government, with the debt spending, it doesn't look good. Let's go to the weekly charts. Hey, Kelly. Communist dictators, not business friendly. No, they're becoming more and more ruthless over there. You have people now leaving China. They're trying to block their exit. Okay, let's talk a little bit about, we went over this. Let's talk a little bit about the weekly charts. How are we poised to close out the week? How are we looking? So this time last week, actually this time Sunday night, I should say. Yeah. Unfortunately, that's an accurate characterization. Sadly to say, and yes, I live here in the People's Republic of New York. So bond yields going into the new trading week appeared as though they were getting ready for a breakout. And as of Monday night, they looked as though they were going to break out. As of the end of business today, they have backed off. One trading day left to go. If those economic reports come out strong tomorrow, expect a rally in the in yields and a pullback on bond prices. Let's check out the closing price action because it was not pretty for bonds today. I was talking about this with members on Market Wrap last night, and I said, listen, watch out for these bond yields. It looks as though we're putting in a lower high, a rounding top on RSI and on stochastics. That is bullish for our gold trade because we took note of some volatility in the gold markets yesterday, and all at the same time, gold, silver, all the gold mining stocks, silver mining stocks, all just shot up at the same time. So it looked like a coordinated move. And sure enough, today, bond yields rolled over. That is bullish for gold stocks and gold. We'll go over how gold is looking in a moment moving forward. We bought more gold and I sold more puts on NUGT. That's a bullish bet on NUGT, trying to average down our basis cost on that trade. And trust me, if I did some back testing on the NUGT selling naked puts over the past year and a half, it hasn't been a good trade to put on. By and large, a loser, but I think that we're at such a good price level right now. And with economic deterioration occurring, it just makes sense to start buying more and averaging in to these names at these prices, especially with gold flashing a continuation breakout this week. I'll go to that chart in a moment. So yields rolling over. As for bond prices, oh, that's Bitcoin. Bitcoin surging. Wow. Almost 62,000. Let's refresh. Same. TLT, 20-year bond ETF, pulled back. It broke out on the week today. One trading day left to go, but it looks pretty good. The chip market. Now, if you're looking for signs as to whether or not gold, the rally is going to continue, look no further than a couple of charts. US dollar, tips, yields. That's all you need to look at. Those three areas. And tips at current are breaking back out. Bullish key reversal bar on the week. Really good price action. And on the day, we had broken out yesterday and we flew out of the gate this morning. So what does this mean? It means that you have traders out there, investors, not traders, investors out there buying up tips. They want protection from inflation. They saw the super core inflation today. It wasn't on the headline, but they knew that it was in the report. They know that you have an out of control government that can't stop spending. So yields rolling over. The only thing that got me today was that the dollar was strong, was very strong today. Initially sold off, then reversed to close up on the day, strong on the week. So I'm very surprised that gold was able to hold its gains today. The gold miners, same deal, with a dollar that flashed a bullish engulfing bar. And that's a continuation breakout pattern. And the only thing I could say is that volume was light. And maybe tomorrow, if we get soft economic data, the dollar will pull back. We'll see. But as it stands right now, the dollar is threatening a continuation move up higher. Talon, KRE down 1.5%. Do we have news? For those not familiar with the KRE is a basket of regional bank stocks I'm not seeing anything new. I'll check the headlines later. This is a pretty big move. On the day, we were down, bearish reversal bar. Actually, we're up. We gapped up. We closed off the highs of the session. I stand corrected. Okay. Let's just check out really quick. I just want to go back to a hourly chart. I want to check the volume here. That's a lot of volume after hours. This 1 hour candlestick is over 500,000 shares traded. And we drop off dramatically. This is probably one big seller here. All right, we'll keep an eye on this. We're approaching the year anniversary of the sell-off in these regional banks. About New York Community Bank. I've heard of it, but I don't know the situation over there, to be honest with you. Was there a report that came out today about them? Okay. Let's get back to the closing charts. Volatility on the week, very weak. Odds favor bulls. Dow Transports broke out last week, doing a retest of the breakout point this week. I believe they had a pretty good day today. Yeah, they recaptured support today after giving it up yesterday. Dow Jones Industrial Average is actually down on the week. I believe it closed down. Oh, no, it actually went positive on the day, late in the day. Just barely eked out a gain. S&P 500 we already covered. Trip Q's weekly chart looking good here, but unlike the NASDAQ, it couldn't put in a new closing higher high. Let's go back to that chart. Let me make sure that I'm accurate there. Actually, no, I stand corrected. It did. It did close with a higher high. Now, I want to go to the daily chart. And here is, I don't think this is the one I wanted. Yeah. Here is another instance. We spoke about this earlier with the S&P 500 breaking that lower band of support. The same thing happened on the Qs just before NVIDIA released their earnings report. We broke support, then we gapped up on the NVIDIA news. Now, the NASDAQ composite is not going to gap up on Dell. It's not going to happen. So, good price action here today, but guess where we closed? Right at the prior lower band of support, which is now going to act as resistance. So that's the reason why I kept the short on. And volume here today was very, very light on the triple Qs. For this type of price performance, it was very light. What were we up? Over 0.75%. We couldn't even put in the average daily volume. Technology, still looking good on a weekly chart, driven by semis, no doubt. Speaking of semis, new all-time closing highs this week. How did they close on the day? Pretty good. But there's no volume. It's a problem. It's a problem. Biotechs have been in fuego. We own this. Oh, pulled back a little bit. We own this. Maybe this is an opportunity to get some more. We may be selling some puts here. I didn't want to chase this. Staples down on the week. Let's go to gold because we're running out of time. And I want to talk about gold for a moment. So gold has been in a bit of a stealth rally. Nobody's talking about it. You go on to Twitter, and you know when gold was ripping back here, all you saw on the headlines on whatever you were reading, CNBC, Zero Hedge, Twitter, all about gold, 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 gold. Everybody was in love with it. Now nobody likes it, but I'm pounding the table on it. The only concern I have is the dollar. That's the only thing. The only thing that's out there is that dollar. But gold broke out last week. Continuation move higher this week, and on the day, we broke out. So a really good performance here on gold. How was our volume? Awesome. Awesome volume. Then you took a look at the gold mining stocks, and we are at some real serious support here. We're still down. These are the junior miners. The junior miners are still down, but they're basing. Step number one for any stock, index, commodity, China, any first step that you must have to end the bear market is you must stop going down. You don't need to break out. You must stop going down. Doesn't mean you go jumping in with reckless abandon, buying the stocks. No, but it's a good observation to make the fact that we're holding support now for week number 3, and we are quite possibly putting in a W formation at which we may be able to break out of. The only caveat I will say here, the dollar's still strong. It's going to be very difficult for the gold mining stocks and gold and silver and the silver mining stocks to rally if the dollar breaks out. The only caveat to that is if there is a geopolitical event that is causing the flight to safety, flight to the safety of bonds, flight to the safety into dollars, flight to the safety into gold. The problem with that is that is your risk off trade. What suffers in a risk-off trade? Equities. Okay, I think we're good. What's silver do this week? Silver's still down, but again, it stopped going down. Let's do some chart requests, and we will call it. We will call this a night to remember. A night to remember, I think. We have the ladies of the Contrarian Trader, Wendy, Kelly. I didn't see Gay on here. Wendy, I don't see Wendy on here, but maybe they're trolling tonight. I got to check the members area. Do we have chart requests? Yep, we do. Jeffrey, busy man, Jeffrey. Newmont Mining. Okay. Let's get to it. Folks, I've been using a lot of terminology like bearish engulfing, bullish engulfing. There's a 5-part video tutorial, my top 5 favorite candlestick patterns. Free, take advantage of it. Also, we're going to be using TrendSpider, automated technical analysis. Use that discount code below and get at least 35% off of their services. I use it all the time for my scanning and my alerts. So let's talk about Newmont Mining. One of the leadership names, the old school players. I'm loving this. I don't even want to talk about this anymore. I love this chart. It's a buy. Yes, we're at the lower band of a support level. We have been putting in lower lows and lower highs. The however is, this is a bounce here. There's a bounce that's about to happen. I'm a buyer on this weekly chart, assuming that we close at or near the highs of the week. I think that we will go up higher. I would be a put seller. I would be buying the common stock. Would I sell covered calls? Yes. I sold covered calls on our NUGT trade today. So that was good to do. Finally, we got some strength. What do? We took advantage of the call skew and we sold deep out of the money call options. That's what I'd be doing here on any surge in Newmont Mining. Daily chart. Okay, so nice gap up. What you could get here is a retracement back down to around, well, let me figure it out right now. About $30 a share, between $30 and $30.50, golden to go adding more on a pullback. Keep a little bit of sensitivity on there. NEM. Boom. Newmont Mining. Set it and forget it. So bullish on Newmont Mining. I would be a put seller here. If I had to make the call tomorrow, what am I going to do? I'd be selling puts on Newmont Mining. And that's a bullish trade, not a bearish trade. When you buy the puts, you are the bear. When you sell the puts, you are the bull. Or another way to put it, you are the bank, not the borrower. You are the casino and not the gambler. What else do we have to go over here? Do we have anything from the audience? Disney for the lovely Jody. Disney. So I got to say, I can't stand this company. There has probably been no other brand better built than Disney. You want to argue McDonald's, you want to argue Coca-Cola, okay, fine. But there's also been no other company that has done more damage to their reputation, to their brand, other than, you know what, I'm going to say Disney's worse than Budweiser for what they did. Ambev, whoever owns Disney. I mean, Bud. However, that being said, they have activists on their board now, activist investors. Bob Iger has to go. I think that if Bob Iger goes, there's a 20% pop in the stock. Automatically, boom, it shoots up higher. Iger goes, this goes up higher. Now, looking at the chart in and of itself right now, am I a bull or am I a bear? I'm a bull. I think it goes up higher. In anticipation of the exit of Bob Iger, adios, Bob. Now, the way I would trade this, I would wait for the pullback and the retest next week of this support level, and I would be a buyer at that price point. What if it continues up higher? I would sell puts. If it comes back down to you, you have the puts assigned to you, or the shares assigned to you at a discounted price, at the price that you want. If they're not assigned to you, well, you just made some money, you put it in your cash in your pocket. Diz, weekly, retest, sell puts, buy, comment, touch, bounce, boom. Daily chart. Yeah, we're going to pull back here. You have resistance right above. You can see the wick, shadow, topping tail, call it cupcakes. It doesn't matter. It looks as though we are probably going to pull back here and do a retest. That's a good thing. It's bullish. If we hold it, we would have put in a new higher high. And then we're looking for a breakout and then the imminent exit of one Mr. Bob Iger, who's already left once before. So I'm sure it's not going to be too hard for him to leave. Michael, Bob, I was listening to HPE, which talk a lot about AI. HPE, what is that? Is that a talk show about AI, which I think the reason for NVIDIA up so much because of, or is that abbreviation for hype? I don't know what HP is, so it's difficult for me to comment on it. NVIDIA is up on hype, sure, but it's got, you have a business that can't produce enough of their own good. They have a backlog. They're efficiently run, and they have 75% margins. The case could be made with their earnings report that there's no reason at current for the momentum to subside. HPE is a tech company. I'm not familiar with them. So the thing about momentum is that it's brutal. Once that momentum ends, it ends quickly, abruptly, and a lot of people go into denial. I look at the chart, and if we hit a peak, We pull back. I always say the test is always at the top. Either we put in a double top or we break out, one of the two. If we break to new lower lows, we short the stock. Simple as that. Momentum is broken. It's done. It's over. Persona non grata. So until such time as that momentum ends, it's going to go up higher. It's going to get more expensive. So can't fight it. Can't fight it. I would not short the stock. And yes, the hype on AI is most certainly a real thing. All right, folks. Thanks for being here. Everybody have an awesome night. Thanks for being here. Like, subscribe. You know the deal. Have a great weekend, and I will talk to you soon. Have a profitable trading day tomorrow. Be well.